Hi there, everyone. You ready for some football? All right. Everybody wake. Nobody's having any kind of hunger pangs or anything like that, right? No, you're all doing just fine. Don't worry. I promise you none of the Northeastern students are going to steal your sandwiches out there. I'm sure that they would not do something like that, right? All right. My name is Steve Pratt. I'm Director of Financial Sustainability at Eurkus, and I'll do, like a 20-minute, I think, infomercial now about Eurkus before I turn everything over to you guys. Is that good?
We expect nothing less.
Okay, yeah, that's exactly what I was thinking. So let me just say a couple quick words to frame this panel. And I think I would start by making an observation about historically the irrationality of nonprofit capital markets. And by that what I mean is in the for-profit world, it's a fairly straightforward and rational system, albeit one that is corrupt and rife with insider trading and all sorts of other things like that. But, on the face of it, it is a rational system where, you start with a small idea, and as you gain customers and have evidence of profitability, you're able to attract more and more capital from private investors, from banks, and so on. In the nonprofit world, and I'm speaking to somebody who was a nonprofit CEO for 25 years, which incidentally makes me either a serial masochist or an eternal optimist. You decide which. I can tell you that it is much easier to get capital for unproven ideas and for aspirations than it is to get capital as you grow an idea and acquire evidence that it has impact. And over the past decade plus, I would say that a movement has grown to try to address this irrationality and organize capital markets into something that is more rational, like for-profit markets. And indeed, just in the last few years, this new phrase, social impact market, has emerged to give us our own little jargony terminology for the capital market. I think we can point to some things, New Profit and its early efforts to establish this notion of mezzanine funding in our world. I think there have been an emerging group of funders who have moved to making major growth capital investments in nonprofits rather than these one-off mini grants. I think most notably nationally, the Edna McConnell Clark Foundation. Here in this local market, both the Smith Family Foundation, which was mentioned earlier, and Strategic Grant Partners are two notable examples locally of foundations that are making major multi-year bets on organizations largely based on evidence of impact, and they're indeed increasing their bets as the evidence accumulates. But these remain exceptions to the rule. And certainly with the start of the Obama administration, the creation of the White House Office on the Social Innovation Fund, I think that was another attempt to try to underpin the growing of these more rational capital mechanisms in the nonprofit market. And indeed, many of the players I've just mentioned are partnering with the SIF on what they're doing. And I think this new term, social impact bonds, is yet another attempt at this, and Bill, sitting to my left here, is going to talk about something that's much broader than just social impact bonds in a moment. But I think it's fair to say that there are significant questions and concerns about the evolution of this model and where it stands right now, and I think those concerns are really rooted in two things. First, the fact that we're betwixt and between the old capital market and the new capital market, and many nonprofits find themselves befuddled as they try to navigate a set of overlapping funders, some of whom act like these new funders that I mentioned, and some of whom still act like the old grant makers with whom we've been familiar. And for somebody like me whose main job is to counsel nonprofit organizations on how to build long-term financial sustainability models, that confusion is great. I mean, it gives us lots of business. But I don't think it's terribly good for the sector. It's certainly not great if you're a nonprofit CEO and you're trying to understand your donor markets. I think there are two core questions that I'm going to raise. I'm not going to try to answer. I'm thinking that our panelists are probably going to answer it, and I may ask some pointed questions if they try to weasel out of it. I think the first question is really, with this notion of pay for success, do we really know what success is? Do we have confidence that we know? And on a related note, are there certain social innovations that don't lend themselves to the sort of evidence-based approach that's required to prove success that are nevertheless socially desirable? And I think the examples that immediately come to mind are interventions that are disaggregated, meaning that you have many players doing many different things as part of a more global theory of change. We were talking outside in the hallway about childhood obesity prevention efforts and the fact that there's no single provider out there that is comprehensively attacking childhood obesity. And we have a client out in Chicago that's doing this really cool cooking program where they have kids getting trained in schools on how to do better cooking, healthier living, that sort of thing. And they've framed their whole social issue around childhood obesity prevention. And one of my concerns as I'm looking at them is there's no way in hell you're stopping childhood obesity by teaching kids how to cook. It's an important plank, but it's just one plank. And so the question really becomes, if you want to pay for performance, how do you pay for performance in childhood obesity prevention, for example, when there's hundreds of little players out there doing interesting things that maybe add up to impact, but we're not even quite sure yet. I think the second issue, and this is something I wrote a case study a couple years ago called Why Nonprofit Business Plans Fail, which it's great late night reading, especially if you're feeling down in the dumps. It'll cheer you up. But I think the key question that I raised in that piece was, if you have evidence of impact, but you don't have a donor market, what do you do? And the particular concern I actually just recently wrote about here in Massachusetts, where the demographics of poverty have shifted dramatically. And there are now, for every one person living in poverty in Suffolk County, 3 people living in poverty in the 5 counties that surround Suffolk. And yet, for every $5 that's spent on poverty prevention here in Suffolk County, $1 is shared among the 5 counties that surround Suffolk. And so you can have a great program with evidence of impact and no customer. You can have all the clients in the world, but no customer. And so part of the question about the rationality of this market is, if the customer is the only force that is determining where the market should go, is that necessarily a good and just thing? Is that a good thing for social impact? So that's kind of my opening bomb-throwing remarks, and now I'm going to turn it over to Bill to talk about the Nonprofit Finance Fund and some of the work that they do. Then Erika is going to talk about the work at Accion, and then I've got Joe down at the end here, who I'm counting on to stir things up a little bit by arguing with the first 2 panelists. You excited? Yeah. Isn't this worth waiting for lunch? Come on. All right.
So I'll start by contradicting almost everything that you said as part of the introduction. See, I think, my background, I work for the Nonprofit Finance Fund. Basically, we're a nonprofit investment bank. And the joke is I used to work for a for-profit investment bank, which became a nonprofit investment bank, not by design, called Citigroup. It's nice to be working for a nonprofit investment bank that intends to be nonprofit and operates that way. But, I think that, in fact, the capital markets and the social sector are very rational. They're just incredibly limited. And access to capital is gained through so few portals that creates some of the problems and the confusion that always surround the discussion about capital markets. And I think one of the things, vocabulary is very revealing when you start talking about capital access and capital markets in the social sector. And I just even looking at the name of this gathering, funding social impact in the new economy. You start to break that down. Funding of social impact. Funding historically in the sector has been really surrounded around donors and charity. You use the term donor. In the new economy, I think you can expect that all funding in the social sector is in fact a form of investment. Okay, and the return on that investment that people are looking for, whether they give grants or make loans or whatever the form they may be, is something in the form of what you're calling impact. And so I want to get into a little bit of that vocabulary about what's meant by impact investing. And I think it'll help kind of frame and focus the discussion from all of us going forward here. What is impact? And we've kind of focused on it in a way that I think is helpful, and say that it's meaningful and measurable improvements in the lives of individuals, families, and communities of need. That's impact. That's what we're all here for, basically. And that meaningful and measurable part is what you're referring to when you talk about what is success and how do you measure it. But that's really what we're looking for in terms of impact. And the big factor that we're seeing systemically in the social sector is the definition of impact has undergone something of a change. It used to be that impact meant if you did what you said you were going to do, and you delivered your programs to the number of people that you said you were going to, that was success. And those are outputs. And what's happening in the marketplace, and the reason this investment and social impact bonds are coming into play, is that the focus is shifting from outputs to outcomes, actually moving the needle and making a difference in the lives of those individuals, families, and communities of need. And a lot of what you're seeing in the evolution of these new elements of the capital markets and the social sector are vehicles that are basically accelerating that transition from outputs to outcomes. And I'll get into some of the things that kind of slow me down in talking about this. The binary trap is something that we get into in this sector a lot, saying, so you don't do outputs any longer, it's all about outcomes. No, in mathematical terms, you still need outputs. They're in mathematical terms necessary but insufficient. In order to be successful now, you need to have outcomes, move the needle for those populations. So that's the impact side. What's the investment side of impact investing? We believe now that all capital in the social sector is gravitating towards a focus on outcomes. That means that investment expects a return. And primarily we start by talking about social return and how you measure it. With impact investing, we're also talking about a whole new generational view towards investing in the social sector. And that includes a blend of social return and an expected financial return as well. That they don't have to be bifurcated like they did for George Soros. Make a pile of money speculating in the capital markets, and to assuage your conscience, you give a lot of it away in the second half of your life. That bifurcation is, I think, going by the wayside as a new generation of investors and folks like the students in this room are saying, I shouldn't have to make investments that separate financial return from the social return. I want both, and I expect to get both. And you don't necessarily even have to sacrifice financial return to do that in impact investing. The problem is there are no vehicles for you to actually do that, are very limited vehicles, and a lot of them exist in the developing world, not in the West. And so there's a notion of impact investing. There's an intentionality of getting both a social return and a financial return, and that blend of social and financial return is inseparable. They're inextricably intertwined. You can't have one without the other. And I'll talk about that in this pay for success structure in a second. And we're seeing that indeed there is a generational shift in that focus about what investment really means, and combining the double and triple bottom line, as they call it, in investments. It's very different than socially responsible investing. Socially responsible investing is trying to avoid the perils of rock and roll, as I call it. Sex, drugs, alcohol, and guns are things you want to avoid in your investments, so it's very negatively slanted. Impact investing is very positively slanted because you want to have those positive outcomes in the individuals, families, and communities of need. So you take this broad category of impact investing, there are lots of ways of doing impact investing. And you're going to hear about one of them here in a second. The other aspect of it is that pay for success is something that was mentioned in the introductory comments. Pay for success is an emerging approach towards financing in the social sector that has a couple of interesting qualities, and I'm going to focus on the values and the linkages involved as opposed to structures like social impact bonds, because those are ways of doing pay for success. So a couple of things happen. With pay for success, private capital provides working capital. Private investors provide working capital to a cohort of nonprofits to address a specific social problem. Okay. Though that cohort of nonprofits, and it can be for-profits as well, but generally they're nonprofits, deliver preventative and early intervention services that at the back end reach outcomes that are very specific. And the one that's most used is a reduction in recidivism of short-term interned inmates, which was a transaction actually done in Peterborough Prison in the UK. And the interesting aspect of these pay-for-success structures is that they focus on outcomes, they focus on early intervention and prevention, and they create savings relative to the legacy costs that governments have for funding high-cost acute care and institutionalized settings. You avoid placement in prisons, you avoid placement in the visits to emergency rooms and into nursing homes. Those are very, very high cost ways of addressing those issues. The savings that are created and the back end of this, by comparison to those legacy back end treatment protocols, is actually a cash flow. And that's kind of the beauty of pay for success. You get basically interim financing from the private market up front that gets you measurable results from early intervention and prevention that saves money relative to the historical ways of doing back-end treatment, and that cash flow from those savings is used to pay back the investors who gave you the working capital up front. The brilliance of that, and the thing that gives me tremendous sort of satisfaction and happiness about our sector, is that it says that social impact, a reduction in recidivism, other kinds of things, has economic value. Okay? That not only does social impact have economic value, it can be monetized. You can monetize that economic value and create a cash flow from it. I know from my days in investment banking, you give me a cash flow that I can identify, lock up, and secure. I can finance anything. All right? And that's sort of why there was so much excitement about things like social impact bonds, which are a way of doing pay for success. That's really, the context that I wanted to give you on all of this, is that the beauty of some of the new notions that are being floated in terms of bringing capital into the social sector and financing impact are that they are ascribing real economic value to the work that we all do in the social sector on a day-to-day basis, and there are mechanisms to then capture that value to allow more sources of capital to come in to fund things that are actually working by delivering positive outcomes. That's the story that we're trying to get to, and it's all conceptual, and we're trying to make a reality out of it. So. There you go.
Phil, that was great. I thought I was going first. Thanks a lot, Steve. I'm just kidding. You've had to look at the slides sitting here, floating in the, my name is Erika, Eurkus. I am with Accion, and I am here with these esteemed panelists talking about microfinance because it really does fit into this discussion. It's by no means a silver bullet for poverty alleviation or even economic inclusion, but it is a tool and it is a program that has worked. It has not worked in some areas. It has worked very well in others, and really kind of comes into play as an example of this kind of work in social enterprise. We can talk a lot about, we hit on all the things that Steve and Bill have talked about. So impact, different funding structures. Should this be done as a nonprofit? Should it be a for-profit? Heavy and hot debates. over some of our banks which have gone public and turned over quite a hefty profit to certain people and organizations. So I wanted to just go through a few slides because I don't think everyone here is familiar with the work of microfinance. So a little bit of background and then just bringing it to the U.S. and to New England for the rest of the discussion today, because that's, of course, most important. So Accion's mission you see here. Our work is, our vision is a world with full financial inclusion. So what does that mean? It's kind of jargon. So some key characteristics: high quality financial services provided at an affordable price, and offering a full range of products and services to small business owners and individuals: credit, savings, insurance, payments, and financial education. So microfinance today reaches over 200 million people around the world. An estimated 2 billion people still lack access to the financial services they need. When people think about, some people say, well, does everyone need financial services? Well, think about life without a savings account, a checking account, a debit card, your mortgage. And if you're poor, is it easier to go without these things, or harder to go without these things? There are over 10,000 microfinance institutions in the world, and only 400 have achieved sustainability. Fewer than 10 offer a full range of products and services. So this has been going on for several decades, but we've got a long ways to go. Accion's mission, a double bottom line: microfinance committed to social and financial value through traditional financial institutions as well as ancillary services and technologies. And that double bottom line, we're looking at developing the next generation of microfinance institutions, so not just sort of the tier 1 organizations, if you will, but some of the harder places to work, more challenging regions. Moving beyond microfinance, so ancillary services and investment funds. And industry leadership. So one thing that we've done is started something called the Center for Financial Inclusion. And that came in part from profits from one of our early investments in a microfinance bank. And that is, got the goal of really putting clients first. And I think that's a really important dialogue in this conversation in terms of, who are you serving, and do they have a voice, and are they well taken care of and respected? So why social finance? This picture here is just a picture that I love. This is a client named Fazio, and she has a small business right around the corner from Yankee Stadium. So I think there's some SUNY students here today. So I thought I would give a New York client example. We have a lot of clients throughout Boston and New England. Fazio supports her family, supports 2 employees, and is really, a typical example of a micro-entrepreneur, hardworking, supporting her family, and a leader in the community. She's got dozens of different types of people who come by her stand every day and chat with her. Here in the United States, microfinance is a lot less developed. What can we do to support these entrepreneurs and really make sure that they have the chance to grow? How can we engage the capital markets? How can we engage the Smith Family Foundation, also a funder? Citibank, also a big funder. We know that there are small businesses in the U.S., as there are throughout the world, that need access to these services. And you'll see an incredible statistic here. If 1 in 3 micro-enterprises hired 1 employee, the U.S. would be at full employment. So in terms of identifying a need, I think this is a pretty solid one. And Accion and even all of the microfinance organizations in the U.S. are reaching just a couple, 1 to 5% of small businesses out there that need their help. So we're on track, and we've got to really look to the future and look to see how we're going to engage the capital markets, social impact financing, even the government, public support, and really be creative about making this work. Get away from, Bill's terrific point of, we don't have a product to do this. We need to figure this out. We do have some funders. In terms of bifurcation, for example, there's some great entrepreneurs who are starting their foundations now instead of, when they're 70, like Soros, right? So they're starting it now and being a lot more engaged in how to make those nonprofits and programs and foundations really work for social change. And so I think that's the future.
Great.
Giuseppe.
Good afternoon, everyone. Bill deserves some applause too. See, that way you can give applause for me.
We need pictures.
So my name is Joe Kriesberg. I'm the president of the Massachusetts Association of Community Development Corporations, which are local community groups. Is the mic not on? Can you hear me now? Oh, I can hear me now. Wow, it's weird almost. I'll start over. Good afternoon. I'm Joe Kriesberg. I'm the president of the Massachusetts Association of Community Development Corporations, and we represent 90 local nonprofit organizations involved in housing and economic development for low-income families and communities around the state. And most of what I'm going to talk about today is not really related to that. But I think the reason I was asked to be on this panel is that I've written some things and spoken at some conferences, and I have a certain amount of skepticism about the direction that this is all going that I've been asked to share. But first, a few opening thoughts is that I think a lot of this comes from frustration, if not anger, at the continued social problems that we face as a society as wealthy as we are. We're angry that there's still so much hunger and racism and poverty and inequality, and we should be. And we should be. The question is, why do we have those things? First of all, those challenges and problems have plagued humans for millennia, so we shouldn't be that surprised that we haven't solved them yet. But it's not just because our nonprofit programs are ineffective or because of the way we fund our nonprofit programs is not rational, although sometimes that seems to be the analysis. But I believe it's because there are a whole set of other people and actors who are actively working against the change we want to achieve. It's not as if we're doing all this work and nothing else is happening in the society. There are meetings like this with other folks who are thinking about how to fund initiatives that will move the needle in the other direction. And that's really important to be aware of. I mean, I'm a big Patriots fan, and I really thought and hoped we'd win the Super Bowl, but I don't think that Bob Kraft wasted his money on Tom Brady because we didn't get the outcome that we wanted. The fact of the matter, somebody else is spending a lot of money to prevent that outcome from happening. And the same is true, I think, in a lot of the issues that we're struggling with. And in fact, I think those other actors have a lot more money and power than we do. And so if we don't talk about how do we change the power balance, then I think we're misdiagnosing the problem and potentially developing the wrong solution. So that's the first comment. The second comment is more optimistic. We have made some pretty substantial progress in some important areas. The one I like to cite, because people I don't think talk about it enough, is smoking. We have reduced smoking in this country by about 75%, I think. Unbelievable transformational change in our society that nobody would have thought could have occurred 40 years ago. How did that happen? Well, it goes a little bit to what Steve was saying about obesity. It was a whole bunch of things that happened. It was institutions doing research. It was tax and regulatory policy. It was church groups. It was Nicorette gum. It was social pressure and peer pressure. To try to isolate one program and say that was one that got results, that's how we reduce smoking, would be impossible. And yet to say, so I think if we want to have that kind of change on other social problems, 75% reduction in high school dropouts, a 75% reduction in hunger, a 75% reduction in crime, we need to think about replicating what we did with smoking, not finding a single program and bringing it to scale. And again, I worry sometimes that the conversation is a little off track because we're not understanding the problem or we're not learning from examples of success. A lot of the, when you get down to now the whole issue of, well, what does work and how do you define success and how do you measure it? You hear two phrases a lot. One is evidence-based and the other is data-driven. And they're both jargony and they both have merit. But I want to make the case for why we ought to be thinking about evidence-based rather than data-driven. To me, in trying to determine whether a program works, data is essential. Just like physical evidence is essential if you're trying to convict somebody of a crime. But it's not the only thing you need to convict somebody of a crime. You need a story, for one, a plausible story as to why this happened and how the events connect, how the physical evidence fits into a pattern. And I think the idea of thinking about marshaling a set of evidence that may or may not prove, absolute certainty, but beyond a reasonable doubt or with, more likely than not type of standard, we can do a better job evaluating programs that may not lend themselves to a simple numerical single metric. So I like the idea of thinking about building a case, using evidence and all the different kinds of evidence as a more thoughtful way to determine which programs, which strategies are working, than trying to boil it all down to a single metric. Which brings me to what I think people wanted me to talk about a little bit is, one of the worries, or some of the worries I have about social impact bonds and pay-for-success strategies. Now, first of all, how could anyone argue against the idea that we should pay for success? Nobody's going to argue that we should pay for failure, and I certainly won't. And everybody likes the idea of a free lunch. Well, if it doesn't work, we don't have to pay for it. That's terrific. But what I worry about is that to make pay-for-success or social impact bonds work, you have to make it relatively simple so that the investors have some way of judging their risk and understanding what they're getting involved in. And I think driving toward that simplicity carries huge risks for taking us in the wrong direction, investing in the wrong programs, and focusing on the wrong outcomes. I also would argue that the more pressure you put on that, the more incentive there is to cherry-pick your clients in order to get the outcomes that you want or that are desired, to rig the system so that the benchmarks you're aiming for are highly achievable so that you'll have success. And we know that powerful financial investors have the ability to essentially game the system so that they ensure that the profit is privatized, the risk is socialized. And I worry that we could fall right into that same trap with this mechanism. So those are a few worries I have about this whole social impact bond thing. The other thing I guess I would say is that as far as I know, there's one implemented social impact bond in the world. It's about 18 months old, and it's far from proven. So the idea that we ought to invest in things that are evidence-based and proven models, those social impact bonds are far from it. It's a good theory. There's interesting models out there. They may or may not work. They may work at some things and not others. But I think before we declare them an absolute guaranteed model, we need to be a little more cautious about that. And I think, there are some, there's certainly, if you go online and start reading about it, you'll find some more cautious and thoughtful analysis, but mostly what you'll find is a lot of cheerleading that concerns me. Final comment I'll make is I just spent a week in Israel meeting with housing professionals there who are trying to build an affordable housing system. And when you're anywhere, I think, but America, maybe there's other countries like America, the groups like ours are called NGOs, non-governmental organizations. But in America, we're nonprofit organizations. And I think it's interesting that we're defined in either case by what we're not. But here we're defined by how we're different from the for-profit sector, which is, I guess, the norm. And in other countries, we're defined as not being the government, where maybe the government is sort of seen as the norm. And I think we ought to try to avoid either box. And, ideally, someday maybe we'll have our own name. Sometimes I refer to ourselves as mission-driven organizations. Hasn't caught on at all. But it's in our mission statement, but nobody ever remembers that. So But I think it says a lot about how we think about the sector and the role of the sector. And some of the things that we do are very much like the government. I mean, charter schools is a good example, is that we're filling in where the government hasn't been effective. And I think we know that there is a role for government, and there is a role for social purpose activity that doesn't yield a bottom line. And we don't want to lose sight of that.
So before I open it up to questions here, I have a couple questions. I'll bet that the other panelists have some reactions to one another that they would like to share. Yeah. I mean, I would say one thing that I hear that actually I don't think is in dispute is the notion that the capital market or the impact market, whatever you want to call it, is too small, too oxygen deprived for what it is that we want to achieve. And you know, I think the only real question is what are the levers to open up that market. You know, I think what is interesting about the social impact bond effort and some of these other things that have come on is, if anything else, you know, I think their virtue is the degree to which they're bringing new capital into the world of getting to social impact. To the extent that they're diverting existing capital to this purpose, I think there's probably greater concern. And as I said in my opening remarks, I think some of that concern has to do with the fact that from the perspective of a nonprofit leader, it can be very difficult to try to navigate different capital markets simultaneously with different kind of bases of reason. I'll accept your point, Bill, that maybe nonprofit capital markets are more rational than they appear to the eye, and they certainly have become more rational than they were 25 years ago when I got into this sector in terms of, if anything, the market for early stage ideas has dried up over the last 10 years, where, you know, there was a period for 10 or 15 years where it was much easier to go into a foundation and pitch an idea that had never been tried before, and they'd be all over throwing money at that. But if you came in with something and said, I've got a 5-year-old idea, it was impossible, or much more challenging anyway. But why don't I ask you, Bill, first, given Joe's remarks, if you want to do a little bit of point-counterpoint here, like the old 60 Minutes?
Well, and you know, actually, Joe and I have talked a lot about this together, and we actually probably agree more than maybe it appeared in this. And part of the reason for that is, and I neglected to kind of point this out, in the Pay for Success and Social Impact Bond field, my organization, Nonprofit Finance Fund, has a very, very active role and a very, very disciplined and carefully defined role. We are what's referred to as an independent, honest broker in that field because we've made the commitment that we will not be engaged in actually trying to execute transactions, because we don't want to have a proprietary, abiding interest in doing transactions. We want to make sure that the enabling environment for this access to capital is built properly, and that it does all the good that it can do with little, if any, of the bad that it has potential to do. So that's the first piece that I would say to this. And I would say part of the excitement of this, you know, and Joe points out, I do this talk all the time about this one transaction in the UK that was done 18 months ago that has created this massive buzz globally. Literally, they're trying to do these in Australia, trying to do them in Canada, and I said it adds a whole new meaning to the term faith-based initiative. You know, but some of that's tied to the point I made earlier about the notion that you're able to ascribe economic value to social impact. That's what kind of gets everybody. And then you combine that with another fact in the marketplace. J.P. Morgan has a group called Social Finance that does a lot of this kind of work in the developing world, and they've looked very carefully at the investor community who might be interested in impact investing. There is a pool of $400 billion to $1 trillion of capital looking for vehicles for impact investing in a world where there aren't any. So there's no bigger incentive in my mind to find appropriate, viable ways to access that capital to bring what we need into this social sector and have the outcomes that we're looking for. So I kind of summarize all this in saying, let's be careful that we don't let perfect get in the way of good. And it happens a lot in this sector. You know, if it's not perfect, it's not worth doing. If it's not applicable to everybody or not accessible to everybody, well, we shouldn't do it because that's unfair or that doesn't really deal with the equity that we're looking for. Let's look at what's good and move from there and see where we can go with it. And that's what I would say back to Joe on some of this stuff. You could take the same rules and apply them to the invention of fire and say that we shouldn't do that. It has a lot of problems with it potentially. So,
don't you see an irony in the perfect good comparison and the approach, the evidence-based approach that's driving funding now?
Well, but evidence and data isn't looking for perfection, it's looking for results. And results that are negotiated and reasonable and satisfying, things like reductions in obesity that you mentioned, reductions in recidivism. So I don't think that, that speaks to perfection so much as it does to a meaningful, measurable improvement in the lives of individuals, families, and communities of need, back to that original premise.
Fair enough. Erika,
yeah,
do you want to?
I was just going to say, and I apologize, I cut short. I saw a 30-second time thing, but now I'm thinking it was the 30-minute time thing when I was standing up there. So sorry for trailing off there at the end.
That'll speed you up, yeah.
Yeah. No, I was just going to say that I agree with that, and I appreciate through what I've seen in this work, a potential solution for different stages. Jean Horstman earlier in the panel talked about having those funds before she needed them so she could work with them. The brand new, out of the gate ideas probably shouldn't be backed by, an impact bond. But for work that has developed over decades and the problem has not yet been solved, but the client and the demand and the need has been identified and it's there, those programs maybe should step up and potentially look at even, getting their metrics to, fit in maybe a little bit more of a box than they might like to if they were really, back in the early days, so to speak. But if that's what it takes to then get the right capital and to get more capital, freeing up other funds for startup ventures, I think that's very important. And you think of the debate in microfinance around turning a profit and profiting from the poor when one of the few organizations around the world indeed does become sustainable because they've reached so many people. And they're blasted for that. And yet you go back to the MasterCard Foundation or Citibank or the Smiths and they say, no, we're done giving you money, figure this out on your own. So there's room, I think, for some stages and maybe different types of work to be placed in different categories.
A couple of things I want to say just about the irrationality, supposed irrationality of the nonprofit capital markets. I think this is way overblown. I'm a nonprofit executive. I've had to raise money from foundations and corporations and government for 20 years. It's maddening. It's hard. I've certainly, vented in my office many a times. But part of a market is that it's a free market in which people are free to make decisions that they want to make. And in that sense, I think the nonprofit market is a lot like the for-profit market. How do a lot of businesses get started? Family and friends invest in their business. It's not based on some objective macroeconomic financial model. It's because a family or friend asks you to invest. It's based on that relationship. I invested in my uncle's business when I was a kid with my $1,000, and he went bankrupt. So I know about that. Luckily, I had some insurance from my parents.
How was that, Seder?
So yeah, well, how it goes. But that's not a unique story. And think about in the for-profit sector, we have. A lot of businesses have relationship managers. Literally, that's their job title. Their whole job is to cultivate relationships. In the nonprofit sector, when a funder gives money based on a relationship, somehow that's not objective. But in the for-profit sector, that's an explicit job. I mean, that's why business people take each other to the Patriots and the Red Sox, is because they're building a relationship. In the nonprofit sector of government, that's bribery, but in the for-profit sector, that's relationship building. And that's because relationships matter. They're relevant to deciding where to invest in. Now I need to say this because I'm a Northeastern alum, and I also understand there's some Binghamton University people. I'm a Binghamton University alum. How many of you that are now in school are going to donate to your alma mater when you graduate? Oh, come on. Come on, Barry, what's going on here? All right. You know, people give to where they went to school not because they've got some report showing social impact, but because they have some loyalty to that institution. It's why we give to our churches and our synagogues. It's why we give to art museums. So I think a lot of donors are looking for that double impact, but a lot of donors are looking for something else, just like a lot of consumers go to Starbucks instead of Dunkin' Donuts or vice versa because of a whole bunch of things, not some rational economic analysis. It's about status, it's about comfort, it's about Pepsi versus Coke. You know, that's why we spend so much time on advertising. So I think it's overblown how rational the for-profit sector is and how irrational ours is. I think there's a lot of similarities. The second thing, just on the social impact bonds, that people should know that the capital is going to be paid by the taxpayers. That's who pays back the bonds. If there's success, the taxpayer is going to reimburse with a profit the investors. Out of the savings